Good afternoon, everybody, and thank you very much for attending our webinar on emissions-linked trading in the US and the EU. Today, we will be discussing, in the context of emissions trading, the underlying asset, the emissions credit, the relevance of the Paris Agreement, the COPs, the EU, UK, and US Climate Change Action Initiative. We will just be discussing emissions trading and crediting regimes, including the voluntary market for carbon credits. We'll discuss, and in fact, we will start off with a discussion of the derivatives documentation platform for trading emissions credits. The three principal platforms for OTC derivatives: ISDA, under ISDA, EFET, and IETA documentation. And then we will go on to discuss the regulatory treatment of emissions products in the United States for swaps, futures, and forwards. I am Ed Parker. I'm the Global Head of Derivatives and Structured Products at Mayer Brown. Up on your screen, that's me at the far right bio. And I'm joined by two of my partner colleagues, Tim Baines. Tim is a partner in our London office, and he has a particular interest and background advising companies and financial institutions on real estate, energy, and sustainability sectors, and in particular emissions credits and the regimes for trading emissions credits. And joined by Matt Kluchenek, one of our partners in Chicago. Matt is in our litigation dispute resolution practice, but he also co-heads the firm's financial markets regulatory and enforcement practice and is a member of our derivatives and fintech practices. And Matt has a deep interest and practice involving emissions credits and trading aspects as well. In fact, before Matt joined Mayer Brown, he served as an Associate General Counsel for CME Group as well. I have a couple of housekeeping items to mention before we get into our main discussion. We are offering CLE credits to those seeking them today for today's session, and we will read out a CLE code aloud when it appears somewhere in the presentation. CLE forms have been attached to the session's calendar invitation and should be completed and returned to the Mayer Brown email address listed on the documents. If you have any comments throughout the presentation, feel free to enter them into the chat box, and we will either cover them during the session, time permitting, or be able to get back to you afterwards. So with that, we will start off the main body of the webinar, and turning over the first slide, please. And we will discuss documentation platforms for emission-linked trading, ISDA, IETA, and EFET platforms. So what we talk about emissions trading, what are we actually trading? Well, it is an emissions allowance. Now, emissions allowances are generally an allowance to emit a quantity, usually a ton, of a greenhouse gas, carbon dioxide being the most common of these. And we talk about the carbon markets, but also certain other greenhouse gases as well. And my colleague Tim will be going into in detail the broader market. So for trading those allowances in the derivatives world, we generally have two main forms that are done: options and forwards, and to a lesser extent forwards as well. And both types of derivatives financial instrument on which this is done are fundamentally very basic contracts. So the most basic form of of option, so either a put option or a call option, so a right to sell or deliver carbon credits at an agreed price at a future date, or to purchase carbon credits at an agreed price at a future date, or with forwards an obligation to buy or sell credits at an agreed price at a future date. The complexity in these transactions, though, is to do with the complexity of the underlying asset, and that requires specific documentation under trading platforms to be in place. And we're going to take a look at those if we move to the next slide. And then on to the next one as well, just a short summary there of the forwards. So the three platforms we use for OTC trading are ISDA, IETA platforms, and EFIT platforms. I'll just mention more broadly, and not the subject of this discussion, that there's also trading that takes place through climate exchanges. There were 10 European exchanges that trade allowance contracts, and nearly 40 worldwide. If we could move to the next slide, please. There are also carbon pools where small emitters pool allowances and match buy and sell orders for trading as well. And we have a booming market in structured notes, which will embed options and forward contracts and swaps in order to trade allowance under structured notes transactions. But turning the next slide, please. What we're focusing on here are the three principal OTC trading platforms. So these trading platforms are provided by three trading organizations, each very different organizations. ISDA, of course, is the industry body for OTC derivatives. Of course, who produce the ISDA Master Agreement and the many series of derivative documentation booklets for credit derivatives, equity derivatives, commodities, and others. The IETA, which is a much more focused organization, which was established for matters to do with the carbon markets and achieving the goals of the Paris Agreement and reaching net zero emissions by 2050, and EFET, which is the European Federation of Energy Traders, which produces documentation for trading of gas and electricity, and is very popular with energy producers in the European energy sector. So moving to the next slide, please. ISDA, what sort of documentation does ISDA produce for the trading of emissions allowances? Well, what's produced and how the ISDA documentation platform works is an extension of the general OTC derivatives platform. So if you look to the right of the screen, we've got a screenshot of the ISDA Master Agreement, which everybody on the call I'm sure is familiar with, is used for trading interest rate derivatives, FX, equity derivatives of all types of derivatives classes, and is amended by means of a schedule. Now, for trading emissions allowances, ISDA has produced series of documentation. Now, the first documentation that was used was emissions trading was inserted into the 2005 ISDA commodity definitions, and a sub-annex H was produced, which set out a form of Part 7, which could be incorporated into the ISDA schedule. Now, the Part 7 sets initially was quite a short part that included specific provisions for trading emissions allowances. Over time, those parts have got much longer, and is now for EU emissions about 37 pages long. Since that date, we have had Brexit, and the UK has its own emissions trading scheme. Interestingly, the EU emissions trading scheme was pioneered and had a practice run in the UK, and then was broadened to go across Europe. Now that as we are replicating in the UK, the European emission scheme in the UK, but we have two separate sets of documentation for that. So we also have a form of Part 7, or it can be changed to Part 8, which will be incorporated into an ISDA schedule for trading. Now, the third element, we have our individual types of confirmation, template confirmation for trading options and forwards, and those confirmations effectively will incorporate the 2005 ISDA commodity definitions and take advantage of the additional provisions provided in the Part 7. You'll see at the bottom of the page, we also have, which we'll discuss in a moment, last year, ISDA produced a set of definitions for verified carbon credit transactions, so the voluntary carbon markets, which Tim will discuss in a moment. Those definitions are incorporated into a confirmation for when to allow trading of voluntary carbon credits. So moving to the next slide, please. Just some snapshots there to show what those parts look like. As you can see, that the trading provisions, if you want to trade EU emissions allowances under an ISDA master agreement, it's this form of Part 7 that is added to two counterparties ISDA master agreement for trading EU emissions allowances. And if they wish to trade UK emissions allowances, there's a form of Part 7. Again, that can become a Part 8 or a Part 9, but these provisions are put directly into the ISDA master agreement. Now, moving on to the next slide. What's covered by this Part 7? And this comes back to what I was saying. It's about whereas the option and the forward that are used to trade emissions credits are fairly basic in their actual derivative element. What Part 7 sets out is the complexities of the underlying asset. So Part 7 covers how to buy and physically settle transactions, fallbacks for what happens and if only some of the allowances are delivered. It sets out fallback for when settlement is disruptive or suspended. For example, what would happen if the EU emissions trading scheme or the UK emissions trading scheme is abandoned. And it sets out terms and fallbacks for when a seller fails to deliver allowances and this results in a buyer being fined for failing to deliver allowances that are required to be delivered as part of the emissions trading scheme. Also sets out warranties, representations, taxes, provisions, and definitions. On to the next slide, please. In particular, there are fallbacks for failed settlements and delivery, and these are settlement disruption, failure to deliver, and scheme suspension events. And we've touched on those a little bit already. Moving over to the next slide. Again, one of the particular nuances of the underlying asset is because the underlying asset is a regulatory creation, there are certain nuances that need to be satisfied. And one of the big things is if in a forward transaction, a counterparty fails to deliver an emissions credit to a installation that is required to deliver allowances under an emissions trading scheme, a penalty can apply. So a fine for not delivering allowances for every ton of greenhouse gas that a power station pollutes. So the parties can make elections depending on who is going to pay that fine for a failure to deliver. So a first election that could be made in the Part 7 or indeed in an individual confirmation is that the party that fails to deliver does not need to pay the any excess emissions penalty. The reverse is that penalty does need to be paid. And we have a third election for a failure to deliver alternative method. And election 1 and election 3 are broadly similar in that they provide for the settlement price should be more or less the price of purchasing other allowances in the market, and there are differences between the two about what costs should be covered. Moving to the next slide. Some quick snapshots here, just showing what the confirmations look like for trading these allowances under the ISDA documentation. And you can see, as I say, fairly simple confirmations, but you can see that there are elections to be made about, as I mentioned, failure to deliver alternative method, whether these excess emissions penalties are applicable. Next slide, please. As mentioned, we also had the 2022 ISDA verified carbon credit transactions definitions that were released by ISDA last year. Very handy set of definitions for counterparties wishing to enter into forward optional swap transactions related to the voluntary carbon market, which Tim will discuss further in his section. Next slide, please. And the final set of ISDA documentation is US emissions allowance transaction documentation. So the ISDA's produced a US emissions allowance transaction annex, which is used, but parties enter into this annex to their ISDA schedule. And this covers allowances that are created under US regional carbon dioxide trading schemes and for voluntary emissions products. So it's a much broader annex that covers trading in those markets. So turning to the next slide to look at the other platforms that are available, IETA has produced its own documentation. It's very similar to the ISDA documentation. There are two sets of documentation. There's a single trade agreement that can be used for entering into a standalone transaction for purchasing or selling emissions credits. IETA has also produced an emissions trading master agreement as well, broadly centered on the EU markets and very similar to the ISDA documentation. The difference being that these agreements are entered into only for trading emissions credits. Our next slide, though, what is very helpful is IETA has also produced, well, actually, our next slide here just shows a couple of snapshots as to what those agreements look like. But moving to our next slide, please, there's also been some helpful elements in there where it sets out forms of option and forward transactions that can be used for trading under IETA. And moving to our next slide, we have the EFET documentation as well. One thing I would mention about IETA is it also has a set of documentation for trading in the California markets as well, which is specifically tailored to trading in the California emission credits market. Our final platform for OTC derivatives trading is the EFET documentation. This is purely centered on EU and UK markets. Now, EFET trading documentation is designed for trading power and trading gas. EFET has master agreements for power, it has a master agreement for trading gas, and for trading emissions credits, there are two sets of appendices. There's a power appendix for trading emissions credits, and there's also in EU emissions credits. There's also one for UK, and there's ones for gas, as well as power for power. So these are a little bit more nuanced. When do these ones tend to be used? These are EFET trading is very popular with the installations, the energy producers. So often we see ISDA documentation being popular for trading between banks, trade of emissions credits who are providing liquidity in the market, trading between banks and asset managers. But when a bank or asset manager faces an energy producer, often it's very popular to use this EFET documentation as well. Now, moving to the next slide, please. We can see that some snapshots of how these documents look. And again, you can see that they're covering very similar areas. It's the suspension events, what happens for excess emissions penalties. So all very similar. And that is intentional, that the three providers of the platforms have tried to work together to provide broadly similar documentation. So turning to the next slide, please. There are though some differences and some nuances between these. So there are differences in how excess emissions penalties are treated. There are differences in the force majeure clauses, which can allow a party not to make delivery. Differences in how settlement disruption and failure to deliver provisions work, and various other minor differences. So where that's important is on a standalone basis, there's nothing significant here. But if you have an asset manager or a bank and they're entering into a trade one side on an ISDA document and hedging that through an EFET or other documentation platform, it is important to be aware of some of those differences to make sure that there's not a documentation mismatch. So with that, if we turn over to our next slide, please. And move on again, please. Next slide. Brian, thank you very much. I will now pass over to Tim, who's going to provide an overview of the carbon markets. Tim, over to you.
Thanks very much, Ed. Next slide, please. Thanks. Well, so what Ed's really been talking about is the documentation in respect of secondary markets in emissions allowances and credits. So once the allowances and credits have already reached the digital registries and then are going to be traded between different registry accounts by market participants. What I thought we'd do now is take a bit of a step back and think about why and how those allowances and credits end up in those digital registries, and also have a little think about some of the documentation, the primary offtake documentation in respect of carbon projects. Before we do that though, why are we interested in this area at all? Well, climate-related risks consistently rank among some of the highest rated risks in surveys of most significant risks facing corporates. That's been the case for quite a number of years now, and we assume will carry on being the case in the future. And emissions trading is one of the main means of mitigating that risk alongside other mechanisms for carbon pricing. Next slide, please. So over recent years, there's been a massive growth in the number of different carbon pricing initiatives throughout the world. And those cover a really broad range of different initiatives, not just carbon trading or emissions trading, but also policy initiatives like taxes and renewables obligations, which you're probably familiar with. On the trading side, emissions trading volumes grew to record levels in 2020 and 2021. There has been a cooling off as a result of macroeconomic challenges over the last year or so. That said, though, World Bank research suggests that revenues themselves from carbon taxes and emissions trading schemes have continued to rise over the last year or so, and perhaps as importantly, the ecosystems around carbon pricing, all the different service providers and market participants, is increasingly growing as a sort of sector. In addition, we see that all the revenue, not all of, but an awful lot of the revenues from these initiatives being ploughed back into the low carbon economy. Next slide, please. So, of course, there are a great many national and sub-national carbon prices mechanisms that have been put in place. And we'll look at a slide showing that shortly. But I wanted to touch really briefly on the international framework that's given the impetus to initiatives for mitigating and adapting to climate change. You'll all have heard of the Kyoto Protocol, under which a number of states agreed to legally binding emissions reduction targets. the second and last commitment period of the Kyoto Protocol has now expired, but it's not history. The Clean Development Mechanism, or CDM, allowed for the establishment of carbon reduction projects in developing countries and the issuance of carbon credits known as CERs. And that mechanism remains in place. CERs are still issued and traded, and a mechanism has been agreed in order to migrate that system to a system under the auspices of the Paris Agreement. Under the Paris Agreement, which I'm sure you've all heard of, and we'll come back to it, negotiations are still ongoing and will continue for a number of years in respect of the establishment of market mechanisms to promote sustainable development. But more broadly, parties to the Paris Agreement committed to limiting global warming to well below 2 degrees, and to use efforts to limit global warming to 1.5 degrees above pre-industrial levels, and are required to submit nationally determined contributions, or NDCs, setting out their plans to reduce emissions. And why is that important? Well, really, the Paris Agreement helps to provide a strong incentive for governments and the private sector to continue achieving emissions reductions. And one of the ways that governments are doing this is by implementing emissions trading schemes. And corporates are helping play their part in this by being actively involved in emissions projects. Next slide, please. So, as you know, parties to the Paris Agreement are continue to meet sort of on a regular basis throughout the year, but in particular, they meet at the end of each year, something called the Conference of Parties to the United Nations of Framework Convention on Climate Change. Next year, very shortly this year, at the end of the year, there'll be another meeting in Dubai, and market mechanisms will again be discussed extensively at that meeting. This slide sets out some of the sort of key theories behind putting a price on the emission of greenhouse gases, and why that's important and helpful. I suppose I should mention that when talking about carbon trading, emissions trading, we tend to use the terms of CO2, greenhouse gas, carbon fairly interchangeably. But one thing to note is something that Ed mentioned earlier, is that what we're really talking about is trading or transferring units which represent a ton of carbon dioxide or carbon dioxide equivalent. The overall idea is that the emission of greenhouse gases poses a cost to society at large, albeit that it also comes with massive benefits, such as energy generation in many cases. But without regulation, people responsible for the emission of carbon dioxide have no incentive to reduce emissions. And so a way that's been developed of regulating CO2 emissions is by imposing a cost per ton of CO2 emitted. And that's a system that's been in place in terms of air emissions for many decades now, and actually probably originated back in the US with the SOx and NOx trading schemes. Ideally, though, the cost of carbon dioxide emissions reflects the sort of cost of CO2 emissions to society at large, and incentivizes people to spend money on technologies to reduce emissions. Those technologies obviously vary, but that can cover things like the use of renewable energy, using more efficient equipment during in the supply chain during production, or using alternative means of production or alternative production inputs. And you can, of course, impose a cost of carbon in a number of ways. You don't necessarily need an emissions trading scheme. So you can, for example, impose a tax on a ton of CO2 emitted, or a blanket tax on certain sectors, or you can just order entities to reduce their emissions, or prohibit the use of particular technologies, for example. But those are all seen as fairly blunt policy responses, and as such, kind of not economically efficient. The theory is that it doesn't really matter if a particular company, as opposed to another, reduces their emissions, as long as the overall emissions are reduced. Equally, emissions can be reduced at home or in another jurisdiction, and the effect on the climate is the same. So the advantage of emissions trading schemes is that in theory, at least, they allow emissions to be reduced at the place of least cost. So, for example, a chemicals company that can most easily reduce its emissions because they're about to invest in some new, more efficient equipment should be the entity that's able to do it, and may then free up some allowances for a company that finds it more difficult to reduce its emissions to purchase from it. The purchase of allowances from the first company should be cheaper than having to invest in significant new technology, for example. That said, of course, emissions trading schemes do bring costs with them. There's a significant architecture that needs to be put in place in terms of setting up emissions registries, tracking transfer of units, documenting transfers, cost of monitoring, reporting emissions, all those sorts of things. Next slide, please. So this slide shows all the jurisdictions that have, in one way or another, put a price of carbon in place as part of their environmental regulation. The purple and blue jurisdictions are all ones where an emissions trading scheme or carbon market have been implemented one way or another. Next slide, please. But it's pretty important to understand that there are two sort of fundamental types of market-driven emissions policies. The first is a cap and trade scheme, and an example of a cap and trade scheme is the EU's emissions trading scheme. So just a bit of background about how those schemes generally work. So the regulator establishes an overall cap on emissions that regulated entities are allowed to emit. And the level of the cap is set below business as usual emissions for all of the compliance entities. Compliance entities are typically large emitters like power generators, big industrial emitters, sectors like iron and steel, cement, and that kind of thing. Regulated entities have to surrender digital allowances, which represent a ton of CO2 in respect of that company's actual emissions, or that installation's actual emissions at the end of the year. The allowances are sometimes issued for free, but often have to be purchased in the EU, for example. There are centrally organized auctions of allowances. Entities with a compliance obligation, so your factory, can buy and sell allowances between themselves or from third-party traders. They can reduce the cost of compliance by reducing their own emissions, by investing in less polluting technologies if it's more economically effective for them to do so. Entities that struggle to reduce their emissions can buy allowances from others instead of reducing their own emissions. But the primary demand source for allowances in these kind of schemes is entities with compliance obligations under the scheme itself, even though third-party market intermediaries are typically allowed to engage with the schemes. So that's cap and trade. The second main type of policy is called a baseline or credit or carbon crediting system. So many standards have already been created as a way to certify that emissions reductions from an emission reduction project have taken place relative to a business as usual baseline. I mentioned the CDM under the Kyoto Protocol earlier. So for example, a wind farm creates less emissions compared to conventional energy generation. As such, a wind farm project can be registered under a standard. Carbon units or offsets can be created that reflect the emissions saved or reduced compared to the business as usual scenario baseline. So a key criteria for those kind of schemes is that the emissions reductions wouldn't have taken place but for the investment in the carbon reduction project. And that's a principle known as additionality, which is actually a fairly complicated principle once you get into the nitty-gritty of it. So these credits or offsets that are produced as a result of the project can be purchased and cancelled by a company wanting to offset its emissions, or by consumers. And you'll all have come across offsets in, for example, the aviation sector to offset your flight emissions. Certain cap and trade schemes also allow these kinds of offsets or credits from carbon crediting schemes to be used for compliance. The EU emissions trading scheme used to allow CDM credits for compliance, but doesn't anymore. Most baseline and credit system schemes at the moment are in the so-called voluntary sector. And there's no legal requirement for entities to purchase credits from voluntary schemes. There is a sort of really important caveat to that, which is that an international aviation emission scheme has been established called CORSIA, and that requires aircraft operators to purchase and surrender credits from so-called voluntary carbon projects that meet certain criteria. And that's going to be a release, or that is a significant demand source of voluntary credits. So looking then at these two diagrams on the screen, in the first example, a lesser emitting factory sells its spare allowances to a heavier polluting factory so that the heavier polluting factory can satisfy its annual compliance obligations. In the second diagram on the right-hand side, in the normal course of affairs, a wastewater plant emits methane. An emission reduction project is then implemented to generate electricity from the methane. That reduces the amount of CO2 emitted relative to the business as usual scenario. The project's registered under a voluntary carbon standard that allows the carbon credits to be generated. And the sale of those credits helps to pay for the upfront emissions reduction technology. The credits can then be bought by a company that's seeking to offset its carbon emissions or by an individual consumer. So that's the difference between cap and trade and baselining credit or carbon crediting schemes. Next slide, please. And again. So the EU ETS in a bit more detail now. The EU ETS is the EU's emissions trading scheme, and it's a great example of a cap and trade scheme that's evolved over time. It applies to over 10,000 stationary installations and to intra-EU aviation. Next slide, please. It's a fairly typical cap and trade scheme compliance year. Entities monitor and monitor their emissions during an annual compliance year. They then have their monitoring verified. By the 30th of April every year, they have to surrender an allowance for every ton of CO2 equivalent that they emitted. The next slide, if you could move on to the next slide. The next slide show how the EU ETS has sort of evolved since its introduction in 2005. I'm not going to go into them in any detail, but the EU ETS remains a central plank of the EU's legally binding goal to be climate neutral by 2050. It's evolved over time to improve how robust it is and to broaden its coverage, to require entities to dig deeper in terms of reducing their emissions. Go to the next slide. And there have been some recently negotiated changes that have now made their way through the legislative process. So the cap has been made even more stringent, and the maritime sector is going to be included for the first time. There are some changes to the way aviation emissions are covered. Free allowances are going to be phased out, moving towards full auctioning. In a parallel piece of legislation, a carbon border adjustment mechanism has been introduced. This is a way of getting around the issue of emissions being offshore to outside of the EU and then sort of polluting products being brought into the EU. So that's now in place, and we're going to see that kicking off very shortly. And a second emissions trading scheme known as ETS2 will cover fuels from transportation and heating sectors. So it's a scheme that's continuously evolving. Next slide, please. So I thought we'd now move on to sort of background to voluntary carbon markets. Next slide, please. So outside of emissions cap and trade schemes, voluntary carbon markets are the major player in the carbon markets at the moment. Voluntary schemes follow the baseline and credit rather than cap and trade model. The main motivation for purchasing credits is to retire or permanently delete the credits from the system. But the credits can be marketed, bought and sold by market intermediaries at the same time. Generally, they're used by corporates to demonstrate good corporate citizenship, and they can be integrated with carbon neutrality commitments. The voluntary markets have come in for quite a bit of criticism in recent years, but there is an organisation that's called the Integrity Council for the VCM that's in the process of trying to address some of those concerns. Next slide, please. And just a quick snapshot of some facts and figures here. I think the key takeaway here is that there are lots of different projects in different jurisdictions and in different sectors, and there's quite a wide range of pricing between different projects. That those are the prices there are no means the sort of only prices, and you can run really high credit prices too for different kinds of projects. But the things that go to pricing in terms of voluntary credits are really quite complicated, and we often work with brokers to establish what sensible pricing might be. Next slide, please. Here's a list of a few of the main voluntary carbon market standards, although VCM gold standard are sort of by far and away the sort of ones that we see the most. Next slide, please. And here we've set out sort of typical project cycle for carbon credits. Broadly speaking, there's different standards follow the same kind of model. The important thing is that there are pre-approved methodologies which are developed, which are used to test the robustness of projects. Projects are implemented, the emissions reductions are monitored and then verified by independent entities. And then emissions reductions are then issued once the emissions reductions have been properly verified by a third party. Next slide. And the ton equivalent of emissions, the voluntary credit ends up in a registry account. And once they're in the registry account, they can be transferred or retired. Next slide, please. I just wanted to touch on VERPAs. So Ed spoke about secondary market documentation. Usually the primary offtake from the project owner is going to be documented by way of an ERPA, an emissions reduction purchase agreement, or a VERPA. There are a number of different provisions that tie back into the project development cycle that need to be taken into account when drafting VERPAs. Next slide, please. Next slide again. So just to say that the Paris Agreement isn't irrelevant to all of this, and there are ongoing discussions about market mechanisms under the Paris Agreement. Next slide, please. And again, and this is a fascinating and sort of continuously developing area. There are a number of sort of big themes that are out there in terms of defining what net zero means, requirements around greenwashing, enhanced disclosure requirements in respect of climate change, the introduction of mandatory transition plans, which all go to thinking about voluntary carbon projects and mechanisms. So that I'll hand over to Matt. Next slide, please.
Thanks, Tim. Much appreciated. Hello, everybody. Matt Kluchenek, partner at Mayer Brown in its Chicago office. So in the last several remaining minutes here, I'm going to talk about the role of the U.S. Commodity Futures Trading Commission, or CFTC's role with respect to environmental commodity enforcement and regulation. On the next slide, please. Tim gave an excellent discussion of compliance or cap and trade versus VCM markets. And this slide touches on some of those distinctions, but as some of you may know, more generally with respect to the VCM market, it is a very actively traded market. There are a number of brokers, there are a number of active traders who are looking to buy and sell, whether it's small amounts or on a relatively large pool basis. There's also a number of exchanges that have sprouted up now over the years that, again, list and actively trade spot carbon commodities. There's also a number of futures markets, including ICE futures and others that trade derivatives or futures contracts based upon spot carbon commodities. Next slide, please. The CFTC in particular, and I think it has largely to do with the trading, the activity and the trading of environmental commodities, as really the primary driver for the CFTC taking a strong interest in these types of markets. And we've had a number of comments from CFTC chairmen and commissioners over the years. The current CFTC chairman, Rostin Benham, has indicated on a number of times, as encapsulated in the quotes here, the real interest of the CFTC in getting involved in regulating and enforcing problematic areas with respect to environmental trading and VCMs. And this topic seems to quite frankly present itself in a number of speeches by the chairman and by the commission, again, really indicating that this is a focal point of the CFTC. The next slide, please. And if we take a step back and talk a little bit about the CFTC and the role of the CFTC, and for many of you, this may be a primer. Keep in mind the CFTC is authorized to regulate what we refer to as commodity interest markets, or generally derivatives based on commodities. And so by regulation, the CFTC can come up with registration requirements and various day-to-day requirements as well. And commodity interest generally means such products as futures contracts, option on futures contracts, and swaps, as well as a few other items. There's lots of futures contracts now based on environmental commodities. One example is set forth there. And importantly, the CFTC, while it can regulate transactions involving these so-called commodity interests, if we're talking about something that is not a commodity interest, but is a commodity, then the CFTC has the authority only to bring enforcement actions if there's fraud or manipulation. And on the next slide, we talk about how the CFTC has recognized spot commodity transactions involving carbon or environmental products, as well as forwards. Those are not commodity interests, but the CFTC is authorized under the Commodity Exchange Act to bring enforcement actions, again, if there's an element or an allegation of fraud or manipulation. And the regime, as it sits today, at least, is very similar to the digital asset, the cryptocurrency regime, from a jurisdictional perspective. And as many of you know, in the digital asset regime, you've got a very active spot trading market, and then you also have an increasingly active commodity interest market, where Bitcoin futures are prevalent or swaps and various cryptocurrencies are prevalent. And in the digital asset market, like the carbon market, the CFTC, again, has only the authority to regulate with respect to commodity interest or derivatives positions, but can only bring enforcement actions with respect to spot and forward transactions. So again, as we sit here today, that's really kind of a focal point and an important point to keep in mind in terms of what the CFTC's jurisdictional boundary is. The CFTC cannot regulate, again, as of today, and probably absent legislation, cannot regulate spot transactions or forward transactions involving commodity, environmental commodity products. Next slide, please. So the next couple of slides actually talk about CFTC carbon-related initiatives. And we really have to go back to 2011, what is it, 12, 13 years ago, when the CFTC last spoke or last addressed carbon-related products in a formal manner. And so that was via Federal Register formal rulemaking, in which CFTC talked about the distinction between carbon as a forward contract, carbon as a swap, what sort of characteristics might turn a forward contract into a swap contract. And there was really a general discussion as part of that formal rulemaking. Since then, there really has been no formal action taken by the commission. There's been tremendous interest. There's been a bunch of groups. There's been a bunch of reports, quite frankly, but there hasn't been yet that formal action. So some of the initiatives, if we look at 2019, going back a few years ago, there was created a climate risk market subcommittee, and that particular committee issued a report, talked about managing climate risk in the U.S. financial system. made a number of recommendations in terms of trying to create a regime that would be friendly to promoting growth in respect of risk management, climate products, including derivatives, so on and so forth. And then things went a bit quiet. If we go to the next slide, please. And we jump to a couple of years thereafter, the CFTC created a climate risk unit, which sought to, again, coalesce and define and identify and enunciate, if you will, the CFTC's interest in its mission with respect to understanding the role of derivatives in respect of carbon emissions and reductions. And then a year thereafter, the CFTC hosted its first, what they refer to as voluntary carbon markets convening. And they followed that up with a request for information, relatively detailed, asking market participants a number of questions and soliciting feedback on essentially what the CFTC should do in regard to some of the issues impacting this market. Very broad ranging, good number of responses, meaningful feedback from a broad range of market participants in terms of issues around risk management, exemptions, techniques, jurisdiction, products, relief that might be appropriate, so on and so forth. CFTC continues to digest those responses. It has conveyed to the market more generally that two areas of focus have been, number one, that the CFTC needs to use its anti-fraud and anti-manipulation enforcement authority in the spot and forward market. So again, somewhat akin to the digital asset regime. And then secondarily, develop some standards to promote the growth of high integrity carbon offsets, so credible products, and come up with mechanisms to promote growth both in the spot market as well as in the commodity interest or derivatives market. And then on the next slide, please. More recently, the CFTC earlier this year created a task force within the enforcement group called the Environmental Fraud Task Force. Really, the name is what it said. The purpose is what the name states, and that is to commence active investigations involving potential abuses, involving spot and forward transactions, environmental commodity related, where, again, there's an allegation or an element perceived of fraud or manipulation. I think the CFTC has historically been very concerned about fraud or manipulation in spot markets because that can impact, ultimately, trading and pricing with respect to commodity interest products. So the notion being that if there is a manipulation in the spot carbon market, that might impact pricing and the credibility of a carbon futures contract over which the CFTC has both regulatory and enforcement jurisdiction. On the next slide, please, and we're a little bit over the allotted time, so I'll do a quick wrap up here. I think there's really 5 or so key takeaways here. We know from the chairman and the various commissioners, carbon trading is going to continue to be a priority for the CFTC. We know that the CFTC wants to have a greater impact in these markets and have a role in shaping these markets. We also know that the CFTC believes that additional regulatory oversight is important and critical for this market. And it sees a framework developing similar to that employed with respect to digital assets. But keep in mind, as we sit here again now, there has been no formal rulemaking, and it's not really clear that one is imminent. Seems to be that it may yet be a while before we see any sort of formal regulatory rulemaking or regime proposed by the CFTC, but we shall see. And then the fourth point there, again, will be a continued focus on enforcement. We're actually seeing an uptick already in the pipeline within the enforcement staff of the CFTC. And just like we've seen a rash literally over the last few years, CFTC spot market digital enforcement, digital asset enforcement actions, we may well see that too in regard to spot environmental commodity transactions. And then historically, the CFTC has been relatively close in working with Maine Justice, which of course has criminal authority in regard to various types of trading practices. We saw that in regard to spoofing. We've seen it in regard to manipulation, so on and so forth. And we would expect that relationship to remain intact where there's significant wrongdoing in the environmental commodity, again, spot or forward or commodity interest market. So that wraps up our presentation today. Again, apologies for going a bit over there. Thanks all for participating. If you have any questions, feel free to email us. And again, thank you much for your gracious time.